All right, what's up traders? This is Ferris with Trade with Tex, and today we're going to be discussing 5 things you need to know to read charts successfully. Okay, so whether you're a day trader, swing trader, I guarantee you're going to learn something from this video and apply it to your trading and think, wow, how did I never have that on my chart? It's not just specifically indicators. We're going to be talking about actual price action, which I've noticed people don't really teach on YouTube that much. And I wanted to mention before we get started, it's only 5 things. Number 5, on purpose, I left it back there, at the very end of the video is a good one. Okay, so make sure you stick around to the end. I've also included a note sheet at the end that has things written out that you would have taken away from this video. Now, real quick, if you are not subscribed to the channel, check it out. We got a lot of good free content on there. And if you want to actually trade with us live, you can join us for a free week in the Trade with Tex chat room. That's tradewithtex.com/sign-up. The link is in the description below. Okay, but let's get into it. We got to knock these out one by one. So first things first, closing prices matter, right? Basically, at any point throughout your trade, whether you're using an indicator or a break of a key level, right, simple breakout trading, you're going to have confirmation, right? And this is a pretty good reminder. Closing prices are basically the foundation of everything we do. They show us supply and demand. They show us who's in control, bulls or bears, right? And ultimately, when we're testing a key area, a big support or resistance level, this determines whether or not the stock keeps moving up or starts moving downward and reverses, right? So, for example, really simple note here. One of the trades from today, Ford, as you could see, had already gapped up quite a bit, right? There was some positive news, so we were a little bit hesitant at the open, but basically it was breaking out. This was the big resistance at 2170 that we had already broken in the prior day. And these green lines, these fib extensions, which we're not going to get into right now, it's a little more advanced, these were our targets, right? And they act as resistance. So if we zoom this into Ford on the 15-minute time frame, for me that's a somewhat larger time frame for day trading, but it applies to swing trading as well, right? You would just be using the daily. For intraday, we're using the 15-minute for now, okay, to see how we react to key levels. But basically, as we go along, if we are closing not only higher candle to candle, right, so the close is above the prior close, so right here to right here, that is bullish, right? If we are also closing above the key level, that is very reassuring that we're going to keep going, okay? So Ford, I actually bought this, I'll show you, on the 4th minute today. It's a good example right here. Bought it just on the continuation right here. I bought common stock and I bought options, so for the sake of this example, this is actually perfect. And then as we went throughout the day, you can see these fib extensions were my targets, and really not a single time did we struggle with one of them. Maybe with this one when we gave it back up at 24.38, but consistently knocked it out, knocked it out, knocked it out, and then we kind of plateaued a little bit here. I had sold on this candle just to take profits. But consistently we had closed higher, right? Closing prices are king. So number 1, closing prices matter. Use that to not only get into the trade, but to stay in the trade, okay? Obviously, if you're a reversal trader, because I know the majority are out there, they're not just trend traders, which blows my mind. But if you are a reversal trader, you would use this for bounces or rejections at key levels, right? So if we had this fib and we were looking for a short off of it, we would want a big red candle to print off of it in order to confirm our thesis and get us in the trade. Okay. Number 2, the 50% rule, which a lot of people don't use, but this is actually a pretty widely used tool from money managers and funds in general. But I use it personally for active trading. So I use it for swing trading and day trading. Basically what it says is that if a stock or security, right, if you're trading gold or something, has given back 50% of a move, then the trend is shifting, right? So for example, if we ran up, if we had stock XYZ here, just for the example, and it ran up from, $50 per share to $100 per share over the course of a month or so, okay? If it comes back, since this is a $50 move, right, pretty easy to do the math on that, if it gives back $25 of that move, okay, and it can't hold that 50% retrace, then bears have now taken control, right? Bulls are no longer in control and the trend shifts downward. This is why, if you learn this rule right off the bat, you're not a bag holder, right? One of the hardest things for me to learn when I first started trading was to cut my losers. For some reason, I thought, you know what, this could come back. It was one of the stupidest things ever. And it's the same thing if you're day trading futures or options. You will let your options expire worthless rather than trying to get some kind of value out of them because you have this false sense of hope with a misunderstanding of technicals. If you understand the text, the rule says 50% or more given back, the opposite side takes control. So, for example, just a really simple thing from today. I shorted Disney today as well. This is a large cap, but this happens with penny stocks all the time too. Disney, if you look at the recent move, it had ran up overnight from, what is this, like 156 and some change up to 160 on that morning pop. So about a $4 move, right? Which basically says that if we give back $2 of this move and close under that $2 point, then it leads to a reversal to the downside, right? Bears are back in control. So Disney, I saw that big gap and I thought, oh man, that is some juicy, juicy downside without any kind of catalyst because it didn't have news, right? So I just waited. That was it. Basically, the easier way of doing this is you take your Fibonacci retracements. You can draw it from the key levels, whether it's the gap or whether it's, a huge run up on the daily time frame. It doesn't matter. You can draw it and then just highlight the 50%. And what I like to do is I actually like to just set the alert. So I'll set a price alert for it. But the fibs, I just drew them from this close to this high for the day. And see how we closed below the 50% line right there on the 15 minute? Right? See how we closed right below it? That right there tells us that bears are taking control, right? And that this is going to drop back down. It's a simple rule of thumb. It's the 50% rule. I use it on a daily basis for candle combos and just active trading, okay? So right there, that was the short signal. I took some puts. I think I ended up trading them 77 cents to about $1.50. It wasn't quite 100% gain. It was like 92% or something like that. But it resulted in a bigger win, okay? And again, notice how I'm using the 15 minute, right? Larger time frames equal larger moves. Closing prices matter. These are things that you should already know, but a lot of people seem to overlook them, and it leads to bigger mistakes. Okay? So the 50% rule applies to every time frame, applies to every single stock that you're looking at. It's universal. Okay? Now, next thing that you can probably already see coming here, I mean, to be honest, this is something I talk about in every video. Use multiple time frames. Super simple one. It's not that advanced. What really gets advanced with using multiple time frames after you've picked them is learning the ins and outs because, for example, like if you're using the daily time frame, very, very different from the 5 minute. If you're using the weekly time frame, very, very different from the daily. Even though there are some similarities, you have to practice with them to get better. And specifically what I'm referring to here is combining the time frames. Like the daily and the weekly work very well together. The hourly and the 15 minute work very well together. And to, kind of spell this out a little bit easier for new guys, I'm referring to the interval here. So like these are the time frames that I use a lot. I'm perfectly fine sharing these with you guys and being open about it. Two of the combinations that I like most, I just mentioned briefly, the hourly, so the 20-day 1 hour, right? And the 5-day 15 minute. Those in combination work really well. And you could see it, for example, if I pulled up Ford today, right? 15 minute was bullish, switched to the hourly was bullish, and then when the hourly told us to ease up, we can stay out of it, right? If we look at the NASDAQ today, it actually kept me out of a futures trade, a bounce on the NASDAQ because I was looking at the 15 and I thought, oh man, that's a nice candle off the support because we had a big support level here. But when I zoomed out to the hourly, this was at, what time was this at? 11:30 a.m., right? Keep that in mind, 11:30. When I zoom out to the hourly, see how the hourly there, 11 to 12, ended up closing red, right? I waited for confirmation. That tells me that it's a no-go, right? That I'm not trying to play the bounce and I shouldn't get in. So it doesn't seem like a big deal, but I avoided this loss, right? I increased the consistency of my trades because if the two time frames match up, the higher and the lower, then you're more likely to get follow through. Okay? Now, multiple time frames, again, if you are active trading, I think that these are some of the better combinations. The 1 and the 5 minute, the 15 and the hourly, okay? The hourly and the 4 hour, by the way, not bad at all, especially for futures trading, right? So if you trade the S&P a lot, this is one that you should be using a lot, okay? And then the daily and the weekly. I like all of these combinations. I think there's a lot of money to be made on any single one of them, okay? Now, next one, second to last here, number 4, use multiple moving averages. I don't know what else to say. I mean, this is a pretty day one basic one. The 50% rule, a little more advanced, something that I don't really put out of chat that much because it's super useful and I don't want just everybody to use it, just the people that put in the effort to learn. This one is a little bit simpler in the sense that most people have an SMA, EMA combination, right? Simple moving average, exponential moving average. Most people understand Bollinger Bands, Keltner channels, MACD, all of these indicators that are based off of moving averages, right? And using multiple. So by that line of logic, you probably already have 2 that work well for you. The only thing I'll add here is that you need to have one lower length one and one higher. That way that you can use them for, any crosses, right? If the lower length crosses above the higher length, then it will be a buy signal, right? Then when it crosses down, that is your sell signal, okay? So normally what a lot of people do is they use the fib numbers, right? 3, 5, 8, 13 for their moving average lengths. I use 8 as one of my main ones, and then 20. These are the 2 moving average lengths that I use the most. So one small, one large, or I guess short and long would be the right way of saying it. But the bottom line is you need one low length, one high length moving averages in order to have a full trading system because this helps you read trend shifts, right? And can also give you confirmation throughout the trade, right? So for example, I'll give you a really short and sweet one here. If we're looking at just the NASDAQ today, see how the 8 starts pulling away from the 20, right? That's telling us that bears are accelerating this move to the downside, right? Momentum is picking up. So it tells us that momentum is increasing, right? Also tells us which stocks to watch. Because if I'm looking at the NASDAQ, right? Not a stock, an index, obviously. But if I'm looking at the NASDAQ and then I go over to, let's say natural gas wasn't too choppy today, but it was a little bit choppier, and you could tell because the moving averages were crossing back and forth more frequently, right? They weren't diverging, they weren't pulling apart. Ideally, you play something that has moving averages that are separating, and the only way you're going to know that is by having a low length and a high length one, right? Simple enough. So I use the 820. A lot of people use the 9, the 13, the 21. Whatever you're comfortable with, this is what works for me. All right, last but not least, and my favorite one of all, understanding position, right? Now, position, you might automatically think, okay, this is my position in the stock, right? I'm holding XYZ shares, yada, yada, yada. That's not what I'm referring to. Position is where the price of the security is, right, relative to its key levels, including the high, the low, the open, the close. Now, already, that's a lot of stuff. High, low, open, close. But it's not just for today, so not to overwhelm you guys too much. But for example, if we have a stock that's breaking above the prior day's high, right? This was the candle from yesterday, and it's breaking above the prior day's high, which happens to be a massive resistance level. That obviously is prioritized over a stock that is still within that range and has not broken out, right? So if you're a breakout trader, breakdown trader, reversal trader, whatever, these are all really important concepts for you. This is the most important one because if you prioritize tickers that are breaking out on multiple time frames, you will get higher consistency, you will get larger moves, okay? The other big thing that I wanted to point out, it's not just a stock that's hitting a new high or hitting a new low relative to yesterday's range. It's a stock that is above or below the prior day's close and the current open. I'll say that again, prior day's close, current open. For example, right, I'll give you an actual chart example here, but just to explain it a little bit better, the prior day's close, a stock that's trading above that is seen to have higher demand, right? When it has higher demand, it is more bullish, okay? It's more appealing to traders. In general, it will perform better, right? It's just how it works. So if a stock is above the prior day's close and is moving upward, that is a very bullish stock. So it will get more demand and you will get bigger, more reassuring moves throughout the trade, right? If it is above today's open, a cross above the open, traps all of the bears that had shorted at that level. So that's why at the opening bell, you find yourself getting head faked a lot, where you buy something and then it reverses back down. When it crosses below the opening price, that creates a lot of sell pressure, right? People who had their stop losses there, people who were waiting for the short entry, that will also in turn influence the price, okay? So the example here, I'll show you just a basic one from today. We can look at Ford again. I mean, this is a really solid one. If you look at the opening action, see how we opened up right here at this price. There is a study, by the way, in Thinkorswim called Daily High Low, which allows you to add the prior day's high, the prior day's low, and I believe the opening price as well, but I'm just going to draw it for you. So right here was the open, okay? Yesterday's close is way down there, so we're already well above that. Okay, if we cross down below this open and stay below it on a larger time frame, like the 5-15 minute early in the day, chances are we're going to fill that gap. That's a really basic strategy that we use in the room. But currently, as you can see, Ford defended that opening price when it tested it again, right? And then crossed above its highest closing price for the day. So not only is this hitting a new high, that's how the average investor is going to interpret this, right? They're going to say, oh my God, new high for the day, I got to chase this up. What's more important is that it's crossing above its higher closing price, which was right there, right? So understanding positions, seeing how a stock reacts to its prior closing prices, prior opening prices, is more important than just buying something on a new high, okay? And again, ideally you want to be trading breakout stocks that are above the prior day's high, above the prior week's high, right? That way we're checking two boxes on a larger time frame that will in turn increase demand, okay? Obviously, if you're shorting, you want this to be the opposite, right? Prior days, prior week's low, okay? And again, at the open, if you're trading the opening bell, if it stays above the opening price, that's pretty significant. If it crosses above yesterday's close, today's open, that is pretty significant, and that can result in a much faster move. Okay, now to wrap this up, because we're coming up on 20 minutes here, wanted to mention these are the notes for the video. I wrote them out beforehand. I think that these are incredibly simplified ways of understanding what information was presented, and I think that's the best way to absorb info, at least for me, right? I'm a visual learner, so I need this charts to see it and believe it, but writing down just a couple of concrete things like this will go a very long way with your trading style. Okay, so make sure you are using closing prices, using the 50% rule so that you're not bag holding and taking bigger losses, multiple time frames, multiple moving averages, and more importantly, understand position. Nobody teaches that on YouTube. I don't know why, but we use that every single day in the chat room. Okay, this is all a part of the Learn to Trade series on YouTube. If you like the video, like and subscribe to the channel as well. And if you want to join us in Trade with Tex for a free week, jump in there, right? See what it's about. Learn from the best.